All right, hopefully everyone can hear me okay. Good afternoon and welcome to the Carrington Market Insight and VCT update for Q3 2021. For those of you who haven't met me or spoken to me, my name's Tommy Fairbank. I assist Mo on the research side with the investment business, as well as assisting the client relationship team as well. So how this webinar is going to work today, we're going to split it into two parts. So the first half is going to be taken by Mo, and he's going to be giving an update on Q3, a recap, as well as looking at the thoughts moving forward and also a summary of our thoughts and some actions we've taken within our portfolios. In the second half of the webinar, Al, one of our directors here, is going to be talking to us about venture capital trusts, or as they're better known, VCTs. We're going to be looking at the tax benefits of these, the evolution of the market, and as well as the current opportunities there are in the universe. So usually at the end of our sessions, we run a Q&A. So this is an opportunity for you guys to ask any questions you may have. And this will run after part 2, so after the VCTs. So you can ask anything, along the lines of, the investment stuff, but also the VCTs. If you are not interested in VCTs or find they're not relevant for you, you can still ask a question and we will make sure to respond to that question privately after the webinar. However, if you would like to wait until the end, we will answer all questions that you put to us. So without further ado, I'll pass you over to Mo, who's going to start with an update of Q3.
Good afternoon. Thank you very much for joining us again, as Tommy mentioned. So if we just spend a brief amount of time on the third quarter and what we have seen over that time. So really, the quarter started with a positive start in continuation of what we saw in the second half of second quarter. So the portfolios were moving upwards very strongly, and that was what we saw in July. But unfortunately, soon after that, we did start to see some concerns over in China. So the Chinese economy was already slowing around that time, which was adding pressure to their markets. And that was followed by several other things that were of concern. So firstly was a crackdown by the authorities on certain industries, some of which were in the large technology area, and others perhaps more famously in the online education sector, which they felt should be a non-profit sector. So those added to the concerns of the markets, created a lot of volatility. That was then followed by concerns around the Chinese property market, and specifically the largest operator there, Evergrande, who had accumulated more than $300 billion worth of debt and were struggling to meet their coupon payments to various loans outstanding. So there were several things happening in the region. Unfortunately, that led to very sizable declines in some of those companies. And of course, that impacted some of our holdings that we have in the region. That actually then followed through to the developed markets. So the Western markets really started to come under pressure in early September due to some of those concerns, particularly around the Chinese property issue. And then I'm sure, as you're all well aware, the energy prices that have been increasing quite dramatically, particularly gas. So there's been a lot of concern around the inflation outlook, what that means for us as consumers, and that just basically added more pressure onto markets. So the Western markets then started to fall from the first week of September onwards, and we're only just now starting to find a sort of floor after that fall. Central banks have also been quite vocal and active over the quarter. So the US Federal Reserve had already indicated that they were likely to scale back their asset purchase program in November. And they've also talked about raising interest rates initially in 2023, but they are now suggesting that maybe even earlier, given the inflationary backdrop. They continue to talk about the idea of it being transitory, but I think the reality is that it may well be transitory, but it's probably going to last at least another year or two before inflationary concerns do subside. And just on that, actually, the Bank of England is probably worth mentioning as well, because in my previous webinar in July, I was asked about the interest rate outlook from the Bank of England, and I felt that it was unlikely. Since then, we have seen, as I mentioned, a very large pickup in energy prices, particularly natural gas. So that's obviously created a bit of a situation in the UK from an inflation standpoint, where the Bank of England might actually have to now act and potentially raise interest rates sooner than we expected. As far as the portfolios are concerned, we generally across, I mean, obviously we operate a number of portfolios, but in aggregate, they were very small gains in some, and in some cases, our sustainable growth portfolio, for example, was the best performer, delivering 1.7% net. So if you just think about our thoughts sort of moving forwards, what we've seen in this recent correction, largely driven by really inflation, is that bond yields have risen again. And we did actually anticipate the potential for this to happen in August. And so right at the end of August, in the last week, we did adjust the portfolio somewhat by reducing some of the exposure to those sectors that could come under pressure, to those sectors that could potentially benefit in a rising bond yield environment. They are otherwise known as the economically sensitive sectors, or the value sectors, and are typically occupied by banking institutions, energy companies, retailers, those sorts of things. So moving forwards, given that the inflation story is likely to persist, we will probably have ongoing bouts of volatility between sectors. So we'll continue to see these gyrations, which you may recall we saw in the first and second quarters, and we've now seen over the last month or so. And it's likely that they will continue into the new year. Again, given that those sort of rotations that we're likely to see, and the prospect of higher or inflation remaining where it is, and central banks potentially taking action by raising interest rates, that could clearly create bouts of volatility in the new year. Having said all that, we still actually think that given we have seen this corrective action now, obviously China, it happened slightly earlier, in sort of early and middle part of the summer. The Western world slightly later part of the summer, and it's only just sort of finishing now. We expect to end the year still on a positive note, and our position accordingly. If we just maybe touch again on the central banks and their more hawkish tone, they are all signaling that they may raise interest rates, but I think the question is just by how much. And at the moment, I don't think it'll be very much, because if we take the Bank of England, for example, in the UK, we have seen a very large rise in property prices. And so raising interest rates quite aggressively and in meaningful amounts will clearly stifle the property market and potentially other asset classes. And so that could actually have quite severe knock-on effects. And so I think they will look to raise, but probably not very much. And so for the US Federal Reserve, probably we're looking at 1%, and the Bank of England potentially 0.5%. Given, as I mentioned earlier about China and the issues that we've seen over there, if you recall, China actually emerged from the pandemic before any other economy did, or any other major economy, and therefore recovered more quickly. And as a result, as is natural in the economic cycle, they then had a slowdown in economic growth early, really starting in the second and third quarter of this year up to now. So the recent data suggests that they have potentially, that process has ended, and we may be stabilizing as far as growth is concerned, and then potentially moving back upwards. whereas the Western world is actually slightly lagging that. And so there's a chance that the Western world will continue to slow down as they are right now into the new year. And so that, coupled with very attractive valuations in China and other parts of Asia, is likely, in my view, to lead to the potential for outperformance in the emerging markets in Asia over the sort of next 6 to 12 months. As far as our portfolios are concerned, as I mentioned earlier, we did make some adjustments at the end of August to mitigate the potential for a pickup in bond yields. Given that we think these gyrations are going to continue, we are probably going to leave the portfolios as they are right now, which is they are not as exposed to any particular sectors as they were before. So they were certainly more exposed to the technology orientated sectors. That is less the case now. And I think going into next year, we are likely to maintain that. So at the moment, we don't have any immediate plans to do anything. However, probably towards the end of the quarter, we will be looking at trying to mitigate some of those particular sector exposures that we have. So we're probably more neutrally positioned, and we'll probably look to add some holdings in there that are more defensive as well. So just a sort of quick summary on that. Has been a volatile quarter, but portfolios have emerged generally with positive returns. We are still expecting to end the year on a positive note, although we may need to be patient. You know, some of you may have heard the Santa Rally. We expect that to happen this year, given that we've already had the correction. But sometimes these things can take a while to progress. So whilst we'd love for it to start immediately, it may not be until the end of this month or even next month before that actually takes hold. We will, of course, be keeping a very close eye on inflation and growth and the various sort of gyrations within the markets, as I mentioned earlier. And we may be looking to act on that. And as I mentioned, we may, one sort of line of thought is that we may reduce some of our developed market equity exposure or adjust it in a way that that's more defensive. We'll of course keep you posted on those changes as and when they come. That, I believe, brings me to the end of my presentation. So I will now pass over to Alistair, who's going to talk about venture capital trusts and that particular market. Over to you, Al.
Thank you, Mo, and hello everybody who's listening today. Venture capital trusts, better known as VCTs. I'll talk about the tax benefits. I'll also talk about the evolution of the market over the last 25 years, and then look at this year's offerings and explain a little bit why we've chosen some of the funds or VCTs over others. So first of all, just a sort of a brief background to them. They've been in the UK now for 25 years. 1995 is when they first came out. And the main aim of them was to attract individuals to invest in British smaller companies rather than stock exchange or listed companies. Generally, the intention was to invest in private companies. Since then, it's been a very good history of investment. Last year, the year before, and we expect this year, there'll be just under £1 billion raised from individuals into this sector, into private companies. And to give you a bit of a background, these VCTs are actually listed on the stock exchange. They are trusts, but they are managed as funds. So they're collections of different investments in private companies. Most VCTs will invest in between 20 or even up to 70 investments in private companies. And they are a collective listed on the stock exchange. And there's plenty of reporting requirements as a result. So they announce results annually and semi-annually. They announce dividends to investors twice a year as a result. So there's quite a lot of visibility of how these private investments are doing. I've mentioned they're listed on the stock exchange, but that doesn't mean that there is really a market for these. So once you buy them initially, you've got to hold them, and I'll come on to the tax benefits and the tax rules. But there's a holding period of at least 5 years. They are illiquid in nature because generally the only buyer of these in the secondary market is the fund itself buying back from the investor. And that generally happens after that 5-year period. But other than that, there's no real reason why there'd be a secondary market. So because they're illiquid, they are high risk. You can't have your money back for 5 to 6 years, as I mentioned. And so they're not going to be appropriate for everyone. They're higher risk. You'd certainly have less in a VCT portfolio than you would have in a pension or ISAs or a general investment account. But they are interesting. So coming on to sort of the evolution, before I come on to evolution, let's just go back to the tax rules. So to attract private individuals into making investments in private companies. Now that's risky. Private companies are generally smaller, they are younger, and in order to attract money into them, there are a number of benefits that have been made available. So the tax benefits are, you get income tax relief of up to 30% on an initial investment into a VCT. If you receive money on a gross basis and pay tax at the end of the year, on your tax return, there's a box on the tax return. If you make a VCT investment, you tick that, and that tax relief will reduce the overall tax you have to pay for that year if you're paid gross. If you receive all your income on a net basis, you will get a tax rebate from HMRC after you've put in your tax return. So not just tax relief on the day of the investment. During the period of holding these VCTs, you'll get tax-free dividends, and any gains made will also be free of tax. So very, very attractive benefits. As I mentioned, the downside is you have to hold them for a period of 5 years at least. And also there's only a maximum you can put in every year as an individual, which is £200,000. These sit alongside EIS or enterprise investment schemes. They tend to be, rather than the collection of private company investments, they're generally one theme or one company. So they're of much higher risk. They've got much similar tax benefits, and you can put more in each year. But we tend to look more at the VCT market because of that spread of different investments. For us, that makes us feel a little bit happier with the associated risk. So just a word about the evolution over time. Back in the early days, most new companies that were looking for investment were renewable energy. So most early VCTs would have been in wind generation, solar power, when governments were offering very attractive 20-year terms for people to make those investments, and they were guaranteed energy prices on the electricity that was created. Over time, that was began to, and sorry, the one other sector which is very interesting was management buyouts. And a few of the current day VCTs still have some of those management buyout assets, which was always a very interesting thing to do. So you'll fund a management to buy out a previous owner, and it was actually the lending of money and some equity investment alongside management, existing management, into those businesses. And that's where a lot of VCTs did very, very well, especially in the days of high interest rates on lending. Some VCTs today also still carry those legacy energy investments as well. So that's all good. It worked very well then. but HMRC and the government felt that there was not enough risk then being taken by investors for the very generous tax benefits that you receive. So in the last 5 to 6 years, there's been a far bigger focus on new small startups with the real idea of creating employment. So that has been the main focus now of the market, of the VCTs, during the last 5 or 6 years. So this year, as I mentioned, it's going to be about a £900 million round of VCTs across probably around 10 different providers. I've got here recent performance. Very interestingly, despite the illiquid nature, despite the fact we're talking about private companies, the rules have forced funds to invest in new companies that in general have been tech orientated, very much data driven companies. And that's been interesting. It was a little bit of a gamble, probably 4 or 5 years ago, into these new sectors. But with the emergence of cloud, with the emergence of increased computer power, a lot of these companies they invested in have been disruptors. And in the last year, and it's been a difficult year for industry and for clearly for markets and all sorts of different places, these companies have been growing at around 80% revenue growth, top line growth during that period, because they happen to be part of the step change in some industries, in particular technology and medical advances as well. So cybersecurity, AI, data analytics, and storage. And a lot of these small companies are growing very, very quickly. And this is the first year that we're now really beginning to see that. And so the performance has been very, very strong. In the last year, we've seen anything between 10 and 30% returns for VCTs. Some of that has been paid out as dividends. Some is reflected in the net asset value of the funds now. And that's given us 3, 5, and 10-year performance, which is up now towards the late 8s, 9s, 10s per annum performance, net of all fees, before tax relief. So there's a good performance and track record that is now being developed amongst, I'd say, at least 4 or 5 very, very good VCT providers. So coming on to who would we recommend this year? So the VCT season, as they call it, really starts about now and goes through to around about March. We've just been seeing British smaller companies. I've got at the top of the list there. They're in the middle of a capital raise at the moment. They've raised 40 million. They've just increased that. They're looking to raise 60. And I think that will probably be closed at the end of October. They've got a very interesting portfolio. 75% of that is now in technology and technology-related companies that are growing very quickly. And they have always traditionally done management buyouts. So some of their book of investments still includes some of those previous investments. And I should mention that even though HMRC changed the rules and said you can no longer invest in these sorts of things, it doesn't tell you to divest. There's no backward-looking change in rules. You can still hold them. You just cannot increase exposure to them. So British smaller companies has got, in particular, one very, very strong company that has just done a round of financing, and we've seen American technology funds come in and take part in this latest round of funding. And 25% of their total overall value of their VCT is in this one UK-based company, which is growing, as I mentioned earlier, at 80% per year. So that's really interesting. You've got yourself investments now in private companies that are growing very quickly in the UK, which are attractive to American investors. And the raise I mentioned, this raise is increasing exposure to what is already there. So unlike EIS, where you do an EIS into a brand new company, high risk, don't know whether it's going to work or not, VCTs, it's a bit like a rights issue, and you're getting already exposure to the portfolio that already exists. So that's quite exciting. Albion Capital has been a firm favourite of ours for the last 5 or 6 years. They have a very similar number of technology related companies in their portfolios now, and they also had a back book of renewable energy as well. So a really good mix. They have 6 VCTs in their portfolio. These VCTs pay out dividends twice a year, and they've arranged it so you effectively get 12 dividend payments a year, one at each month end, and they're tax-free. And I do know from my own situation that you get rather hooked on seeing these payments come into your account each month. So that's Albion. Baronsmead, Albion launches in January this year. So there won't be anything to do until January, but we will be in touch before then. And indeed, we've got a seminar we're going to hold with Albion at the end of November, which we'll hold as a webinar so that anyone who'd like to be involved can be involved. Baronsmead launches very soon, in a couple of weeks' time. They're interesting in that some of their book is actually listed investments in the AIM market that qualify for VCT investment. And they also have a good stable of private companies as well that, again, are very tech focused. The fourth one, which is opening again in November, and Octopus is the market leader in terms of size. So they're now about 1.2 billion. Baronsmead is around about, I think, between 400 and 500 million. Albion will be 550 million, and British smaller companies around 400 million. But Octopus is large, and they've had a terrific year, 30% return this year. One of their main investments that has done very well is Kazoo. They were a previous holder of Zoopla, and so they've done extremely well this year. And we have no hesitation with any of those 4 companies making an investment there. There will be other VCTs, but at the moment, knowing which ones are open, these would be our 4 recommendations for the year. And as we said up front, any questions on these, please, we can answer them on the call, or very happy to do it offline. And I'll hand back on that note.
Brilliant. Well, thank you guys. Thank you both for sharing and imparting your wisdom. We've got a couple questions on each, actually. So Mo, I'll start with you. You mentioned that you expect to see outperformance in China in 2022. Will that reflect in an increased allocation within the Carrington portfolios?
Yeah, we're actually already been allocated to Asian emerging markets this year, and so I think our allocation to the region is probably at the upper end of where we would based on sort of historical measures. So I think that's why I mentioned earlier that portfolios, I think, are generally well positioned going into next year.
Brilliant. Okay, and then secondly, just on that, you mentioned you were thinking about potentially reducing our equity exposure into 2022. Would that reflect in a lower return in the portfolios in general?
I think that there is the potential for obviously you don't really know what the return is going to be over the course of each year, but what we are anticipating is some volatility at the earlier part of the year. So it may not necessarily be a reduction in equity allocation. It may just be an adjustment so that we are slightly more defensively positioned. But yeah, I think I wouldn't be surprised if the sort of first half of the year, or the first quarter at least, will be more volatile. But yeah, I mean, who knows what will happen over the course of the year? Well, time will tell, and we'll obviously make adjustments to the portfolios accordingly to navigate the environment that we're in at that time.
Brilliant, thank you. And Al, just a couple on VCTs as well. You mentioned that some of the companies have been held, for quite a long time. Is it typical that companies are held for that long, or is the turnover kind of slightly higher or lower?
Interesting. So some of the British smaller companies, so some of their management buyouts were financed over a 10-year period. So that governs why some of the investments are still held 10 years later or nearly 10 years later. The majority of the books now that are being run follow the new rules, which are only 5 or 6 years old. So in the last 5 or 6 years, we've not seen huge turnover at all. We've seen additions as these VCTs have raised money. In the last 12 months, we've seen the first signs of sales. And that reflects that it's taken 5 to 6 years for companies to build up to critical mass, to look attractive to buyers, especially in the business-to-business space, which, for instance, Albion is very strong at. And we've seen in the last 12 months, they've made sales of business-to-business software companies. Siemens bought one of their investments last year. So I think we're at the start of perhaps the realization of some of the investments that were made 5 or 6 years ago. As I mentioned, the funds hold between 20 and 70 investments. So I think we'll start to see 2 or 3 a year being sold by each fund. So yes, I think we're going to start to see a pickup in that. All of the funds have told us, though, that if that were to be the case, they'll pay proceeds back as extraordinary dividends on top of the regular dividends. And that reflects the rules which state that if you do make a sale, you've got to reinvest the money within a year into a new investment. And some of them are finding that might be a bit too tough. They don't want to be forced into making investments they don't want to do. So rather than that, they'll rather pay back investors. Now, the dividend yield at the moment is around about 5% on all of them. But I think we can expect it now to go up a bit towards sort of 7% a year to reflect those realizations.
And would those sales, because it's reducing the size of the portfolio, does that increase the risk within the portfolios?
It's got the ability to, yes. The risk profile is changing slightly because in that 5 or 6 years, some companies are growing more quickly than others, and therefore some of the winners might be sold sooner rather than later, which is great news. But it might mean that what's left behind, there might be a little bit more risk, or it might be a little bit more time needed for them to mature. It's difficult to say. All I would say, I've looked at the top 10 holdings of Albion and British smaller companies recently, and all 10 are growing at least 40% per annum at revenue, up to 80. So what I like about it is that there are 1 or 2 really strong, and then there's a second level of between 8 and 10 that are not as strong, but they're coming through. I think by the very nature of VCTs being a collective of many different investments, that makes it less risky in the first place. So it's going to be interesting, but at the moment I see this as an opportunity with a little bit more risk perhaps, but there'll be a bit more return as well.
Sure, brilliant. Well, that's all we have for questions at the moment. But as Al and Mo both said, if you have any other questions you'd like to ask us privately, you can email either of us and we'll be sure to get back to you. But otherwise, thank you very much for joining. Mo and Al, thank you for your contribution, and hopefully we'll see you all at the next quarterly webinar.
Thank you.
Thank you very much.